Thor Industries, the world's leading RV wholesaler, this week hosted their 2022 Investor Day. It was a chance for Thor to interact with investors and analysts and share some of their long-term business targets, how much they want to do in revenue a few years out from today, how much they want to produce in operating cash flow and earnings per share, and actually also some greenhouse gas targets. And this is the first time that Thor has hosted an Investor Day for a few years. So I thought it would be a good chance to dive into some of the numbers that Thor shared throughout their Investor Day and some of the questions that came up from analysts. There are some pretty impressive numbers presented as targets for what Thor wants to do by 2027. And I thought it would be a good opportunity to kind of dive into some of the assumptions that they're sharing and what that could mean for long-term investors. Now, I've done a few videos here on the channel on Thor, and I didn't expect to make another one for a little while, but I think there was too much good information not to kind of share in this video. So I do hope you enjoy it, and let me know your thoughts on Thor's Investor Day and some of the numbers they presented down in the comments section below. Now, there's a lot to get through, so let's pretty much dive straight into it. But before we do that, we do have a sponsor for today's video, and this video is sponsored by Hatch. Hatch is the platform that I personally use for all of my US investing for me as a Kiwi based here in New Zealand. And Hatch is asking you to think about what your big and small tomorrow goals look like. For me, the goal has always been financial freedom, putting a little bit away today, with the aim being that I can do the things that I want to do tomorrow. And everyone's tomorrow looks different, whether you want to buy your ultimate dream car, travel the world, or become financially independent. Reaching your goals starts by taking the first step. That's why I invest with Hatch, to help make my plans a reality. And if you want to get started investing with Hatch, check out the first link in the description, where you can get a free 20 New Zealand dollar top up when you make your first deposit of 100 New Zealand dollars or more before the 31st of December 2022. Now, as I always say in these individual company videos, these are just my thoughts. Please do your own work if you want to consider Thor as an investment for yourself. But I think there's some pretty interesting information to kind of work through. And Thor definitely isn't the first business to put out some lofty long-term targets of what they want to do from a financial perspective. Companies do it all the time, and often they're kind of big stretch targets that they just throw out there as audacious goals, and it often comes at the same time as maybe there's like a new CEO or management team and all that sort of thing, and they want to build up a bit of hype around the stock and that sort of stuff. So I think it is kind of a nice exercise to actually work through and look at what some previous projections have looked like for that particular business. In this case, we'll look at some previous Investor Day projections from Thor, which they did a few years ago. And it's also nice to just look at the management team that's in place. You know, are these targets coming out from a brand new management with a new set of, compensation arrangements? Or is this a management team that's been in place for a while and has a history of executing on the targets that they put out there? Now, this Investor Day with Thor went for about 4.5 hours. I watched about the first hour and a half and then listened to the remaining 3 hours or whatever it was driving home yesterday. So I'll try and give you my highlights. But initially, just looking back at those kind of previous projections that Thor have put out there, they had their previous Investor Day in October 2019. So it's been a few years since they hosted one. And they said in that 2019 Investor Day, they basically laid out some 2025 goals. So we're still not at 2025, but they've actually basically thrown those 2025 goals out the window. And that would usually be a red flag, but luckily for Thor, the reason they've thrown those 2025 goals out the window is because they've already met those goals in 2022, a few years earlier, or at least most of them. I'll get to the caveat with that in a sec. So they said they wanted to have 2025 sales of $14 billion. They are already at $16.1 billion for the last 12 months. They wanted to have a gross margin of 16%. They've already achieved 17%. And from financial year 2020 to financial year 2025, which is actually 6 financial years, they wanted to generate a cumulative $3 billion in operating cash flow. Now, we're currently about 45% through that period of time, and they've already produced 56% of that operating cash flow target. So they're about 3 years early on hitting the revenue and gross margin targets, and they are well ahead of schedule with their operating cash flow targets that they laid out back in 2019. So for that reason, they have given some brand new goals which take them out to the fiscal year of 2027, and here those goals are. So they want to get to net sales of 20 billion. That would be an increase from the trailing 12 months sales of 16 billion. They want to get a sustainable gross margin of 17%, and for the trailing 12 months, they're actually already at 17%, but it has been a very unusual couple of years in the RV industry, and they have just gone through a significant boom. And potentially we might see a pullback in their gross margin in the short term. So sustainably, they want to be at 17%. They want to achieve earnings per share of $27. In the last 12 months, they have earned $19.56 per share. Again, that is quite significantly higher than what they've done in the past 2 or 3 years, but that is the goal. They want to generate $6 billion in operating cash flows cumulatively over the next 5 financial years. In the last financial year, they did $989 million in operating cash flows, and they want to reduce their greenhouse gas emissions by 40%. And again, not financial advice by any means, but just so investors can get a rough idea of what that could mean for the upside in Thor stock if they were to achieve those numbers. The 10-year average simple just PE ratio for Thor is about 16. It flies around all over the place because Thor is a cyclical business. The earnings are volatile, so the PE ratio is fairly volatile as well. But 10-year average is about 16. So if they were to achieve that earnings per share target, that would imply a future stock price of about $430 versus the current stock price of about $75. If we used a more conservative multiple of only 8 times, so half the sort of 10-year average multiple, that still implies a stock price of about $216 again versus 75 today. So somewhere between a 3 and a 6x plus kind of dividends if they were to trade at a historically average PE ratio and they were to achieve these underlying business targets. Now, the other thing that isn't explicitly said on that particular slide of business targets, but is talked about quite a bit through some of the other parts of the Investor Day, is that the $27 in earnings per share target does imply quite a bit of share buyback. So there's quite a few kind of less shares outstanding in 2027. Thor already had a buyback program in place of about $250 million. They've already kind of used up about $100 million of that, about $150 million remaining, and they've actually, which they announced at this Investor Day, just gone out and got an additional $450 million in buybacks approved by the board of directors. Now, they presented again some quite, in their view, conservative assumptions around how much stock that would actually allow them to buy back over the next few years. And they estimate that even if the price does lift up as they continue to do these share repurchases, they think they can probably buy back about 14% of the entire amount of shares outstanding. So that will be a pretty significant contributor to reaching that $27 in earnings per share targets. It will be made easier if the stock stays down and they can repurchase a lot of shares cheaply, and it will obviously be made tougher if the share price were to shoot up and they can't execute those buybacks at low prices. So at a high level, those are the key quantitative takeaways from the Investor Day, is that they plan to earn $27 a share in 2027, and part of that will be fueled by a lot more share repurchases. Now, for the rest of the video, I want to dive into much more specifics around how they will actually execute on that strategy. And there was some information that I got out of the Investor Day that I'd never heard before, in particular how they think about acquisitions, which have been a key growth driver for Thor over time, and they actually said they plan on having 0 big acquisitions over the next 3 years. So a lot of that growth in the 2027 target will be organic, but we'll talk about that a little bit more in a sec. And some of the information that they gave in the Investor Day around acquisitions actually gave us a bit more insight around the prices that they typically pay for these companies. We have had prices announced and revenue amounts of the companies that they're acquiring announced, but we often don't get a lot of clarity into the earnings that those new businesses will add. So we got a bit of info on that. and also a bit of information about how they think about acquisitions kind of philosophically in terms of what return they want to generate for shareholders. So Thor did present some of their long-run free cash flow and return on invested capital numbers. So 5-year return on invested capital sits at 18%, and this chief operating officer was asked, do you guys tend to focus on generating high returns on invested capital, or are you more focused on growth? And they basically said, well, we try to do both. We won't acquire something in order to grow the business unless it generates a higher return on invested capital. So it sounds obvious to most people that that's kind of the thing that you'd want to see, but unfortunately not all management teams have kind of that view. Often they just want to grow for growth's sake, but Thor want to make sure that they're doing their growth profitably. One of the other things I found interesting is that Thor has been profitable now for over 40 years straight, which for a cyclical business is exceptionally impressive, and a lot of that is to do with their relatively flexible cost structure. So although Thor wholesales RVs, they aren't like a heavy machinery metal bender like a General Motors or Stellantis or someone might be. They have a lot of flexibility in their costs. They are more in the business of assembly as opposed to bending metal, I guess. And Thor, I don't think, have ever explicitly come out and said we think this much of our cost structure is variable and this much is fixed. But their main competitor in the public markets, actually Winnebago, has come out and said that. And very recently they said that about 85% of their costs are variable, and they have a pretty similar model to Thor. So should there be a big downturn, Thor can turn off a lot of costs very quickly. There was more than a 50% decline in wholesale RV shipments in the 2008-2009 financial crisis, and Thor still generated cash through that period of time. Peter Orthwein, one of the founders of Thor, who took the company public in the 80s, got up and spoke briefly, and he's still a major shareholder actually. And he just kind of reflected on some of the growth that Thor have had when they first went public. They had about $26 million in sales, and they've just done $16 billion, which is pretty crazy, and profitability has kind of continued along with that. Even if we look over the last 9 years, our revenues compounded at close to 17% per year, gross profit at about 20% per year, and earnings per share at about 20% per year. Net cash from operations getting up close to 20% per year as well. So some pretty impressive growth, and a lot of that, like I say, has been done via acquisition. And here are some of the results from some of the bigger acquisitions that Thor have done. In all cases, they have basically said that they won't acquire a business unless they think they can add significant value. In other words, they won't acquire the business unless they think they can either significantly grow it or significantly improve the profitability, and ideally both. And this is kind of the history of what they've done with those previous acquisitions. So with KZ, they have increased the sales 154% since acquiring it in 2014, and they have grown the net profit before tax margin from 4.8% to 13.8%, which is just incredible, and they've done that across a few of their businesses. A couple of the more recent acquisitions, obviously earlier on that journey of increasing margins, and Erwin Group is actually down with margins, which I'll talk about in a sec, which is kind of their big European business, but nonetheless pretty impressive results there. And although they didn't say this number specifically, the indication I kind of got from watching the webcast was basically they won't put money to work. And specifically they said, we won't put shareholders' money to work unless we think we can earn, getting close to about 20% returns on our acquisitions. Thor did talk about a couple of practical examples of how they intend to increase their gross margin, and one of the things that will be an opportunity for them is basically automation. They gave the example of their laminated sidewall line. Laminate sidewalls are one of the parts of many of the RV products that have the highest frequency of warranty claims, basically. So there's human error that comes into that, and that's a big kind of culprit for warranty claims that Thor is having to basically take care of, and they can basically improve the quality, standardize the quality, and do it cheaper by having those processes automated. So that's an example they gave of how Thor can increase their gross margin and get to that sustainable kind of 17% level. Another way in which they expect they will increase their gross margin is through a slight divergence in what they've done traditionally with their business model, which has generally been very focused on RV and towable brands. And in more recent years, they have made the occasional acquisition of a parts business. And in many cases, these parts businesses are basically supplying almost purely to Thor companies anyway. That's not always the case, but they gave the example of AirXL, which is a business that has much higher gross margins than many of their RV brands. Now, I want to spend a little bit of time talking about really two core different geographies that Thor operates in. We have the US business, which is like the shining light at Thor and has performed exceptionally well over time. And then we have the European business, which they acquired in sort of 2018, 2019, and frankly has been a little bit of a drag on margins and hasn't performed as well through this recent boom as the US business. And there's a couple of reasons for that. Basically, the North American kind of CEO, I think he's called, got up there and talked about the North American business. We then had the Airstream CEO get up there and talk about Airstream as one of their specific brands. And we then had the European CEO get up there and talk about what's going on in the European business. Now, there's not a huge amount to say about the US business. It's just like incredibly dominant. They have a number one product in every single category in which they operate in. They're very profitable, have great gross margins, and they continue to kind of make improvements in the way that they run their business. They've made some slight modifications to their decentralized management, so it's a little bit Berkshire Hathaway-esque in the fact that head office doesn't have a huge amount to do with day-to-day operations, but they're starting to have slightly more to do with day-to-day operations in terms of centralizing things like sourcing parts and materials and trying to get better costs for their subsidiaries and their different brands, and also building things like technology platforms. So Thor has an app, for example, that RV owners can download and they can put in, I want to go to this campground. Oh, it's booked out. Maybe I'll go to this other campground. Actually, I've got a really big RV. Can I even drive over that hill? What are the roads like? I've got this issue with my air conditioning. Can I book someone in to get it fixed, or can I scan a QR code to show me a little tutorial video on how to get it working and I forgot to turn it on or whatever. That type of stuff is being centralized, but the management of the brands and the talking to the dealers and so on is still much more decentralized and sits with sort of each individual brand CEO. Now, the European business, the Erwin Group, which like I say they acquired a couple of years ago, does have several things that are different from the US business. So they tend to work with much smaller dealers, literally to the point where some of these dealers might have 3 or 4 vehicles that they're selling or something, as opposed to these huge, RV retailers that Thor works with in the US. So much smaller dealers, much more languages. So the European business works across 9 different languages. Traditionally a lot slower product development, which Thor are working to speed up. It can take them at least 2 years sometimes to develop a new motorized RV model, and Thor have recently got that down to less than 12 months in a couple of cases. It's about 80% motorized versus about 80% towable in the US. They have much smaller RVs, which they have a specific category that they call urban vehicles, which are basically just a van with some modifications. They've struggled a lot with major chassis shortages recently. So a lot of these motorized RVs, they'll basically get a chassis from like a Mercedes or a Stellantis, and then they will modify that to make it, an RV product. But due to chip shortages and so on, which many auto manufacturers have struggled with over the past couple of years, that's had flow-on effects to the Erwin Group. And as a result, they basically had to stop taking orders, and dealers have very low inventories of products still. So that's an issue they're working through. They have much lower gross margins than the US, which, although it's been a drag on the business compared to the US, it's probably where a lot of the latent kind of earning potential in Thor sits, is improving those gross margins. And interestingly, up until a couple of years ago when Thor acquired the Erwinheimer Group, they didn't actually even track dealer inventories. So you have a wholesaler pumping out RV products all the time, selling them to a dealer who will then sell them to the customer, and the wholesaler has no idea how much inventory is sitting on the lot of a dealer, which is kind of crazy. That's a very closely monitored statistic in the US. So Thor have started tracking that for the Erwinheimer Group now, and if we look at those inventory numbers for the dealers, we are much lower than where they were a year or two ago. So again, there's probably some latent kind of sales potential there just to refill dealer inventory, which is explained, I think, a lot of the really good growth that Thor has had in the US in the last year or so. Up here is some industry research on what the growth in the European market is likely to look like over the next few years. Thor mentioned several times that their sort of customer makeup has changed a lot in recent years, and it's got a lot younger. Baby boomers used to be a very important market for Thor in both the US and not so much in Europe, because Europe's a newer business, but presumably it was similar there. And baby boomers are now about only 20% of Thor's customers. They have a lot of kind of Gen X and millennial customers coming through, which you would think is a very good thing for the long-term kind of trajectory of the business. Now, like I said, potentially one of the biggest opportunities for Thor is improving the profitability in the European operations. And they did specifically release a target around that they want to increase the gross margin by 200 basis points, or 2%, between now and 2027. So that would take them from 13.8%, which is pretty thin, especially by the time you add in all of their operating costs and you get down to an operating margin. There's not a whole lot of profitability left when your margins are only 13.8%. So they want to lift that to 15.8%, and the European CEO actually said, they might not be too happy about me saying this, but I actually want to get there a little quicker than 2027. So that was cool to hear, and I think that will explain a lot of the added profitability that Thor are looking to get. Part of improving that gross margin will simply be through passing on higher prices to customers, but part of it will also come from improving the efficiency of their operations, much like I mentioned with the laminated sidewall example in the US. And finally, there is a lot of short-term noise around a business like Thor. They tend to be the type of company that gets hit first when there's sort of like a macro downturn or recession. They tend to be one of the first companies to notice it, but they also tend to be one of the first companies to kind of come out the other side of things like a recession. Now, they did actually give like a downside scenario in their sort of recession playbook or down market playbook, just so people can get a feel for how that might look. They gave the example of what the business would likely look like if they had about a 35% drop off in sales. And keep in mind, in the financial crisis, they had about a 53% drop in sales, and from their peak in 2018 through to the depths of COVID 2020, they had about a 32% drop in sales. So each kind of downturn that they've had, they have remained profitable. Each downturn that they've had, they have been more profitable than the previous downturn, and that's kind of what they suggest in some of the latest downturn or recession playbook numbers that they present here. So I won't speak too much to the figures exactly, but you can see them on the screen here, and some of the levers that Thor are able to pull with their flexible cost structure to make sure that they don't start burning cash. So there was quite a bit covered there, but those are my highlights from the recent 2022 Thor Investor Day. So I do hope you enjoyed it. If you've got thoughts on anything covered in the video, definitely let me know down in the comments below. Always kind of keen to hear what you think in there. And it's a pretty interesting example, I think, of a business potentially that will have some short-term headwinds, and there's a fair bit of short-term fear. I mean, in the Q&A session, for example, the company had literally just spent 3 or 4 hours talking about these are our long-term targets. We don't manage the business quarter to quarter or to meet a particular earnings number in the very short term. We manage this business for the long term. And then literally the very first question from an analyst was, what trends have you seen in the wholesale to retail kind of market over the past 2 or 3 weeks? weeks, not even months or, or quarters or anything like that. So it's a pretty weird situation where analysts can be very short-term focused, the business can be very long-term focused. I definitely prefer them to be long-term focused, and yeah, very interesting case study. Hopefully you enjoyed the video. But that's it from me for this one, and I will see you in the next one. Cheers.